Well, good morning.
Good morning.
I would think that you guys have gotten an earful already and lots of charts. And I was thinking about it. I said, gosh, they sure look like they could use some good news, you know. But I remember, gosh, I've been doing this for a long time. I mean, going back to the early 80s. And I remember, I think it was when the Gulf War back in the late 1980s and the economy was weakening. And I said, you know, what people really want is the truth. And I was thinking about Harry Truman. And a reporter once asked Harry Truman, he said, what do you think about people calling you, give them hell, Harry? And he says, well, I don't really give them hell, I just tell them the truth and they think it's hell. So it's like, you know, that's basically my philosophy. I'm just going to tell it like it is. And the other thing that I've learned is that, there's been a lot of crises that I've been through over the years. And a crisis is always an opportunity for somebody else. And that is always true. And the one person that has made the most out of crises seems to be Warren Buffett. He always seems to be there with, he always seems to be there to get the most opportune terms on whatever deal is in play. What I thought I'd do to start with, though, is just talk a little bit about Silicon Valley Bank. And I know that it's been in the news and a lot of people have heard a lot about it, but I watch a lot of coverage, and I don't think that they've explained well enough how unique the circumstances were at Silicon Valley Bank. There are a couple of things that were missing in that discussion. I mean, and that just kind of annoy me. Now, some of them are very straightforward. I mean, Silicon Valley Bank, just like the name implies, their primary customers were in Silicon Valley. They were a lot of tech startups. Some of them were startups. Some of them were mature firms, but a lot of them were startups. And the way a startup works is they have a great idea. They say, hey, I've got a great idea for this app. It's going to make everybody's life simpler. And they say, oh, that sounds good. Let's see it. And they say, well, how are you going to make money off this? They hadn't figured that out yet. First, we got to get more people using it. Then we'll figure out a way to monetize it. Yeah, that sounds like a plan. Here's our Series A round. And then how's it going? Got users look at this user growth, get a B round, a C round, a D round, an E round. I mean, there's no logic to A, B, C, D, and E, except for they follow the alphabet, A, B, C, D, and E. And you can call it 1, 2, 3, 4, and 5. There are different things like angel investing, and there's also a late stage venture capital and things of that sort, but they don't really correlate to the A, B, C, and D rounds. In any event, every time a startup gets a funding round, they deposit that money in the bank. And since they were all Silicon Valley Bank, they all deposit in Silicon Valley Bank. Well, they had lots of cash because it was very easy to raise capital when interest rates were zero. And the stock market was looking pretty lofty. And so everybody was saying, hey, I know, 30 of the 40 bets that I make are gonna totally wipe out, and maybe 2 or 3 are gonna be really worth it, and that's gonna be it. That's the way the venture capital world works. And they're counting on these companies making an exit. And you make an exit through one of two ways. You either do an IPO and you go public, or you sell to somebody else. And both of those channels got shut down a little over a year ago when the Fed started aggressively raising interest rates and the stock market began to stumble. And that was March of last year. We began to see the NASDAQ stocks sell off the most. And so that meant that it was tougher for companies to go public. And since it was tougher for companies to go public, it was tougher for them to raise capital. And if it's tough for them to raise capital, that means that they have to depend on what they've got in the bank because they're not profitable, they're burning cash. That's their language, they're burning cash. So what many tech companies were doing, and you heard about it, all these tech layoffs, you didn't hear about many of the smaller companies, but in December of 2020, so it's still in the midst of the pandemic, I remember speaking at a tech leadership forum in Silicon Valley, although we did it virtually, which that was one of the handicaps of working for a bank that's headquartered on the West Coast and you being on the East Coast, is that my presentation was at 11 p.m. East Coast time, and I already started early in the morning. And they preceded that with a wine tasting because things were still going fairly well in Silicon Valley. So of course you had a wine tasting before you had the investment presentation. But my advice at that time was that companies needed to secure at least 3 years of funding. They needed to go out and get more funding and to have a cash hoard. And a lot of companies did that, and then they also laid off a lot of workers, and you've seen a lot of the layoffs. Well, that was the initial drag on the deposits of Silicon Valley Bank, which kind of developed into a stampede when people realized that, the folks at Silicon Valley Bank realized that, hey, you know what, we need to go out and raise more capital, because if not, we're going to have to start selling our securities in our held-to-maturity portfolio. And just the word that they had hired Goldman Sachs to go out and raise more capital. I mean, Silicon Valley Bank was trading at $300 a share. Now, I personally did not buy the stock, but one of my investment advisors, when I looked at one of the portfolios, did happen to buy the stock like about 3 days before it collapsed, which I don't know what I'm paying him for, but didn't buy much of it. But but still, the value of it is zero. So it came as a big shock because a bank like Silicon Valley, which was not insolvent, they didn't have credit problems. They did have a mismatch of their asset liabilities, and they had made a mistake. They had underestimated how quickly their deposits would drain. Now, part of that problem may have been that they didn't have a chief credit officer. And they didn't have a chief credit officer from the period from April of last year until I think January of this year. So that poor chief credit officer joined right as the ship went down. That is unusual. That is highly unusual. In my dealings with the Federal Reserve, the way that conversation should have gone, and I think would have gone, if Silicon Valley wasn't as politically connected as they are, I noticed that you don't have a chief risk officer. What's your plan to replace that chief risk officer? What safeguards do you have in place? And it doesn't matter what the answer was, unless it was, we're going to have someone starting tomorrow. The answer from the Federal Reserve would be, well, that's not really what we wanted to hear. We're going to place somebody in the role of chief risk officer at your bank tomorrow. They have that power, and I don't know of any circumstance that they would not do that. I mean, that just, in my life, I just never seen it. The closest corollary that I saw, which wasn't close at all, when I first started, I worked at Barnett Bank down in Florida. In the head of our asset liability area, which is responsible for balancing the books each day, so that you don't know, you're either selling funds or you're buying funds from another bank, and hopefully everything's balanced out. We were deposit rich. But on that day, he had a heart attack. He survived, but he was in the hospital. Of course, the area's in disarray. And we had to go to the discount window. And we went to the discount window, and the Fed said, gosh, we're sorry to hear about what happened there. And we understand completely, but we would like to come down and review your risk management policies and see why you didn't have a contingency for something like this when it happened. And a team from the Federal Reserve Bank of Atlanta, came down the next day. Because that is the way risk management is supposed to be run at the Fed and at banks. You're supposed to have contingencies for these things. And so I think most banks do. And when I hear, when I wrote about Silicon Valley, the Silicon Valley Bank's problems really erupted on Employment Friday, on March 10th, when I was writing about the employment report that day. And I said, the employment report, it's the biggest report of the month. It kind of sets the tone for what the Fed's going to think. And I said, well, Silicon Valley Bank blew that all away, because after that, we're back to not really knowing what the Fed's going to do, because they're more concerned about this crisis at Silicon Valley Bank. It also set off problems at all the other regional banks, because people said, well, gosh, if those risk management problems were that great, could these other banks have problems? Now, at Wells, we had one of the, I think the largest or the second largest correspondent banking relationship, correspondent banking network in the country. And I spent a lot of time visiting banks all over the country. They were also our customers. I worked in the investment banking function, so we did we sold them a lot of investments. Of all the regional banks, for one thing, if you did business with us, and there was thousands of banks that did, I think we have 6,000 banks and get 3,000 correspondents. You had to already come through a risk management filter. But nobody, I mean, I've never had a question about anybody's asset liability area in terms of how their bond portfolio is structured. I mean, I haven't seen anyone that had been as out of whack as Silicon Valley was. And nobody else has that concentration of deposits. Now, whenever you have a bank failure, everybody always looks for who's next, what's next, who's next, what's next. And so Signature Bank, which was tied to crypto, and again, the only similarity it had with Silicon Valley is they had a high concentration in a risky area or a volatile area. And they were thinly capitalized and they went under. The Credit Suisse situation is somewhat unrelated in that Credit Suisse's problems date all the way back to the last financial crisis and never really fixing that. But again, because everybody's looking at what comes next, there's a lot of people are nervous. And if depositors are nervous, that is very dangerous for the banking system, because the whole banking system is based on the idea that people have confidence in the banking system. And and that's not, we're not past that hurdle yet. I think we should be. I have great faith. I guess one of the pet peeves that I have in this when I turn on the news is that on CNBC, which I'm very familiar with, they talk about the problems at the regional banks. I said, there really are no problems at the regional banks. The regional banks have great risk management practices in place. I'm not worried about the big regional banks. In fact, like PNC, Truist, US Bancorp are three of the best run companies in the country when it comes to asset liability management. So those are just three that I'm just at the top of my mind. I could come up with others, but I'm not worried about the regional banks. I am a little concerned about some specialty lenders that have that narrow deposit base, that we may see other problems that I'm worried that it could flow through to other problems. Today, the issue of the day is Deutsche Bank, which, similar to Credit Suisse, has problems that date back to the 2008 financial crisis. And the way that this worked back in the financial crisis is that when we had an issue, and the regulators had an issue, they're pretty good about keeping it close to the vest because they don't want them to get it out. They tend to try to work on it and get it done by 6:30 Sunday night. Because at 6:30, the Australian market opens. And I knew this back in the last financial crisis. And I remember when Fannie Mae and Freddie Mac went into receivership. And I got a heads up from somebody who said, hey, can you be in the office today? And I kind of put two and two together that was going to happen. And basically had a report written on Freddie Mac and Fannie Mae going into receivership that was ready to go right when they announced that they went into receivership. But we're back to that today. And so you turn on CNBC Worldwide at 6 o'clock or 6:15 or 6:20, and you'll see that. And same thing happened with the pandemic. The Fed made their announcement on how they were going to add all the liquidity to the system. They did that at 6:30, or right before 6:30 on Sunday night there in mid-March. So that's a couple of points on Silicon Valley. There were a couple other things I was going to say there and then move on. When it comes to the Fed's job, this crisis is probably going to do some of their work for them. Because for every 10% pullback in bank stock prices, credit conditions tend to tighten the equivalent of about a 25 basis point increase in interest rates. Now, there's going to be more credit tightening than just that. We've already seen more than a 10% pullback. My sense is that the tightening in credit will get a little bit worse between now and June, or maybe now and July. Because what's going to happen in June is that we get the annual bank stress test results. And in recent years, those bank stress test results have really been important because it told the banks how much stock they could buy back and how much they could raise their dividends. This year, the bank stress test results are probably going to result in the Fed telling the banks how much capital they're going to have to raise, either through stock sales or debt issuance, or preferred sales. And because of that, banks are going to want to slow credit growth. And they're also going to be paying, they have been paying very good attention to credit quality throughout the cycle. And one of the amazing things, you saw what happened to home prices. That's happened with mortgages really only being available to people with the very best FICO scores. There's been very little credit risk in the mortgage market, and delinquencies are very low, and I don't expect them to go very high. So that's one of the things to look out for. The other thing that's likely to cause credit to tighten is that in July or August, we are going to have a showdown on the debt ceiling. And I always get accused of being too far to the right or too far to the left, and I said, that's good, because I'm just ripping off the Band-Aid and telling you what it is. And but the reason why I know this is going to go to the mat is, one, you saw what's happened to interest cost. One of my favorite ways of talking about the interest cost for the U.S. Treasury is that China owns, somewhere about $1 trillion of our debt. They don't own that much, actually, but they got up to about 2 trillion, so it's somewhere between 1 and 2. But the interest on our debt is just about the same as the Chinese military budget. Now, their military budget they get one advantage over the U.S. in that they don't pay their soldiers much. They have a lot more of them, but they don't pay them all that much. But our interest cost to us is more than our defense budget. So just putting it in those kind of stark terms, this can't continue. And so from the Republican side, they're in a little box, as I said, hey, well, your guy was in there and you had control. You didn't get spending under control. And that's true. But what's happened with the pandemic and under Biden, is we did the $1.7 trillion increase in spending when he came into office, for really no other reason than if he didn't do that, he couldn't take credit for anything good that happened in the economy. That's really why from politically, that's why they passed the 1.7 trillion. But what that did is that raised the base for federal government spending. We haven't had a budget passed by the Congress and signed by the president since the last year of the George Bush presidency. So when you hear people say, all this should be taken care of in the budget, it shouldn't be taken care of now when the credit card bills do. The fact is, these guys don't pass a budget. They just operate under a series of continuing resolutions, which keeps that spending line going, which can't happen because of what's happening with our interest cost. So that's something to keep in mind, and I think that for the Republican side, they realize that if they don't stand up and try to do something on spending, then there's a good chance there's going to be an opponent that they're going to have to run against in a primary before the 2024 election. On the Democratic side, they realize that, hey, every time we've had one of these battles, we've won. Even if we've lost, we've won. Because they've got the media at their back, and they can blame the evil Republicans because they're not the ones the Democrats aren't the ones pushing for it. It's the Republicans pushing for it. And if you're going to get a deal, whether it's, if we go back to under Obama where we had the spending caps, which is probably something that we're looking at again, or some sort of tax increase, that's not going to be all that popular. So, that's where I'm kind of going with that. I guess to wrap it back with Silicon Valley Bank, I don't know that we're going to see, I don't think we're going to see a rash of bank failures out there. Credit quality is very, very good. bank asset liability management is very good, but we're not at the end of the current banking crisis. We're still in a crisis mode. As for what that means for the Fed, they may be done raising interest rates. The stock market today had sold off and bond yields had plunged, and the financial markets are betting that the Fed's going to cut interest rates by the end of the year. I don't think that's going to happen. And I don't think, unless we have a much more severe financial crisis, the Fed is not going to cut interest rates. One of the things that has changed at the Federal Reserve is they realized that the zero interest rate policy was a mistake and that it created a series of bubbles. And rates are not going back down to that level again. A low level for the federal funds rate is probably going to be somewhere in the neighborhood of 4. That's going to be a low level for the federal funds rate. A low level for mortgage rates is likely to be somewhere in the level of 6. Not to say that they won't be lower than that at some period of time, but those are the new normals. That's where we're going to. Really, where we were before was trying to defy the law of gravity. I mean, it just didn't make any sense. The interest rate should equal the time value of money at a minimum. The opportunity cost of money at a minimum. The opportunity of cost of money is the real growth rate of the economy over time. Let's say it's 2% because we're kind of hemmed in now. Let's take the Fed's inflation target of 2%, which I don't know they're going to be able to get back to, but that's 4, so you add those two together, and you add in the time value of money, and I'm going to be conservative on that and say it's 1/4. That tells me that at a minimum, the federal funds rate over the next 10 years and the 10-year Treasury over the next 10 years should average around 4 1/4. And we were below that at a time where growth was actually stronger than that. So you can't do that. We can't operate at that. When interest rates are below those long-term norms, it means that folks that have access to capital can buy assets, and the returns on those assets will be greater than their carry costs. So that basically the mother of all carry trades, which is one of the reasons that we've had a series of bubbles. And that's why the Fed and central banks around the world realize that the zero interest rate policy is over. On the flip side, if we don't do something about deficits, our interest costs are going to be sky high. And so it's like we're already sky high. I mean, our interest costs are going to become unbearable. The other thing that I think eventually is going to happen, we're going to see this with Social Security. We're going to have to see that taxes are going to have to come up, and we're going to see that the full benefits from retirement, that age is going to have to go up. It's not going to affect people my age, thank goodness, but it'll affect people that are probably under 40. I mean, it'll be phased in over time. But that's going to happen. It will not be actuarially sound after 2028 unless we do something during that time period. So it'll be interesting as we get into a presidential election year as to how truthful people will be with you. I don't know if they'll be as truthful as Harry Truman. I've got a lot of slides, a lot of charts, and I don't want to go through all of them because I know there's a little slide fatigue, but in terms of inflation, before we had Silicon Valley, that was the thing that was on everybody's mind. It's like, when is inflation going to come down? Inflation has been coming down, but it's proving to be sticky in certain parts of the economy. And the Federal Reserve Bank of Atlanta has done a good job on that front. They publish a sticky price index. The part of inflation that Jay Powell likes to look at, he says, let's look at services prices, let's strip out energy, and let's strip out housing. And when you do that, that's still 56% of what households purchase each month. And inflation at that level is stuck at around 6%. This is why everybody prior to Silicon Valley Bank was saying the Fed needs to raise the funds rate to 6% or more, because historically, in order to bring inflation down, you've had to bring the federal funds rate above what the prevailing rate of inflation is. What I think has changed now is that tightening in credit conditions may be good enough for 3 more tightenings. I feel like it's at least 1 right now. It's still possible that the Fed raises rates in May, but I think it's looking less likely. In terms of recession, soft landing, or something else, I have been thinking that we've been dealing with something else. We've had a rolling recession in the tech sector. And if you go to my website, and I'm a one-man band right now, so it's, if you go to my website and you look at the last forecast I published, which was the first forecast of the year, it hasn't changed all that much. But at that time, it had the same line in there, and that, it looks like this line, the last line in the third bullet there, the latter, or a rolling recession, already appears underway. The tech sector, housing, and commercial real estate must have slipped by me when I get it. Could be updated, and will likely spread to the financial services for the financial services this year. I think I could probably amend that and say in financial services it's already there as well. I do think that we'll fall into recession in the second half of the year. I think that recession, you hear a lot that the recession will be relatively mild. The National Bureau of Economic Research is the body that is responsible for defining when a recession began and when one ended. And nowhere in the definition of a recession does the word mild appear. Because a recession is a pronounced, prolonged, widespread decline in economic activity evident across employment, output, income, and business and consumer spending. Now, there are many different definitions of a recession. That is my own, but it's kind of a quicker synopsis of the NBER's definition. But pronounced means that it has to be a significant drop. Prolonged means it has to last for more than a couple of months, although the last recession did last for just 2 months, which was the pandemic. And widespread means that it impacts most sectors. And I don't think so. Maybe it'll be as mild as it can be under those circumstances, but everybody's going to feel it. I mean, that's what happens in a recession. In terms of the housing market, home prices fell for the first time in 12 years. It kind of got lost in all the banking news, but they're likely to fall, I think, hardest between now and the middle of the year, because we're going to be compared with the peak levels of home prices a year ago. We're expecting prices to fall between 15 and 20% from peak to trough. And the peak was around June of last year. That was the peak in home prices, was around June of last year. We're down somewhere around 7% so far we're down 12% if you use the National Association of Realtors numbers, 7% if you use Case-Shiller. But we're down, so we've already made between a third and a half of that drop. My sense is that prices will bottom out either late this year or early 2024. Now, this metro area was a little late, and the reason why it was a little later than the rest of the country is we've had this affordability migration that's been going on really since the housing market began to recover in 2011. And that affordability migration began, one of the first cities that saw housing prices take off was Denver, Colorado. And they got inundated with Californians bailing on California, selling their house at a high price, buying something and paying cash, or mostly cash, for a house in Denver. And then Denver got too expensive, and they went to Boulder, they went to Colorado Springs, they just went up and down the Front Range. Then the whole thing got ridiculously expensive, and they said, heck, we're gonna go to Salt Lake City, we're gonna go to Phoenix. And so all the Western markets dealt with this before the rest of the country did. Heck, I think Denver's population growth, the growth rate peaked in 2015. So this is how long ago it was out there. Those markets have already seen about a 15% drop in home prices using the Case-Shiller numbers, and San Francisco has seen the largest drop in home prices. So we're seeing that prices are dropping a bit more out west. The south is where everybody's moving to. And you look at, I was looking at the comparison that Dr. Smith put out there. I said, Asheville, the only people that can afford to buy homes in Asheville today are rich Californians. That's like, they're the only people. I was in San Diego, and I was speaking at a economic outlook for North County of San Diego, big tech market. Had 4 people come up to me, tell me they were selling their homes in San Diego and moving to Asheville. 4 different people at that one presentation. I thought that was a record. And I thought, well, you'll be in good company. I mean, it's, but home prices there are just ridiculous. And so Nashville, home prices have appreciated a lot. And so what's happened is people have begun to look at alternatives, and that's why Knoxville, and then this metro area was a little bit further away down the alternative, and it was relatively affordable. There are no relatively affordable areas anymore. So it's so I would imagine that the peak in prices will probably be a little bit later here, and a little bit slower to develop. I've got a couple of charts that I know the print may be a little bit small for you, but the left is real GDP. I had mentioned that a recession is a pronounced, prolonged, widespread decline in economic activity. Most people think it's 2 consecutive quarters of declining GDP, and last year when we had those 2 consecutive quarters of declining GDP, I got so many questions from people saying, Mark, did Biden change the definition? I was like, oh man, turn off the TV, come on. It's like, it's not, that didn't happen. He doesn't have the control of the definition. It's actually a non-political body, although everything's political, but it's a nonpartisan, there have been good people that are at the NBR. I have good trust in them. The reason why we had those 2 declines in GDP, though, were largely due to swings in inventories. We have all these supply chain disruptions and in international trade because China's locked down. If you look at the demand, gross, final sales to domestic purchases, which is gross domestic demand, it was actually stronger in the first half of last year than it was in the second. And then when you net that all out over the course of a year, because it usually nets itself out over the last year, both of those numbers rose by 0.9%. Now, that's kind of the good news on 2022. The bad news on that is that the economy grew just 0.9% and the unemployment rate fell. Well, that tells me that our potential growth rate for the economy, how fast we can grow without having inflation accelerate, is no higher than 0.9% and probably lower than that. So if the Fed wants to get a soft landing, it's going to have to be between 0 and 0.9%. It's really simple algebra to come up with that calculation, and and that makes the Fed's job real tough. If they're going to achieve a soft landing, they're going to have to slow the economy to something like 0.4% and hold it there for a couple of years. That's a tough thing to pull off. We are adding lots of jobs. In the month of February, we added 362,000 jobs. About 1/3 of them were at restaurants and bars and hotels, which are doing relatively well. I travel a lot. They're always full. You need reservations, and it's one of the reasons they're always full is they don't have enough staff because they still have about 250,000 fewer people working at restaurants, hotels, and bars today than they did before. The average earnings for someone who works at a restaurant, hotel, or bar is $27,000. There are higher paying occupations there. So about 1/3 of our jobs are there. We're also adding jobs in home health care. We're also adding jobs in daycare. All of these are relatively low paying jobs. That was more than half of the 360, more than half of that 500,000. We're losing jobs in higher paying occupations. It's most evident in the tech sector. There are 2 areas that really haven't seen a lot of weakness, although we're beginning to. Manufacturing employment has been holding up because there's a lot of job openings in manufacturing, although we did have a small decline last month. And construction employment is still real high and likely to remain high because even though housing, home sales and home construction are slowing, there's a lot of homes that are in the process of being built because that process has been stretched out, and that's going to keep things going for a while. Not going to go through all of these again, but I'm just going to hit the high points here. One of the reasons why the Fed is still so committed to raising rates and holding rates high and warning us that inflation is not likely to come down all that quickly is that wage increases are pretty broad-based. What I have here is the proportion of companies that are raising compensation, which is 46%, and the proportion of companies that are raising prices. Now, early on, I went to our trade association meeting in September of 2000, and we had Dale Brainerd and Charlie Evans, who was president of the Federal Reserve Bank of Chicago at the time, and they were talking about why inflation was transitory. And I was sitting at a table with older economists than me. One of the guys was getting hired me out of college, and so he's getting the award, so I sat next to him. And I turned to him, and this guy is really proper. I mean, he's a very proper guy. And I said, John, what do you think about this? And he said, Mark, it's the same bleep that they said 30 years ago or 40 years ago. I guess it was 40 years ago. It's like, no, he said, it's the same bleep they said back in the 1960s and 70s. And I was like, wow. And then I can't say who I went to see. I can't even tell you. I'll tell you that they were a research director at a Federal Reserve Bank. And so that narrows it down to just about a dozen people. And I said, do you believe this? I mean, is this consistent with what you're seeing? And he looked at me. He looked at me in the eye and said, Mark, let's go get a drink. So this whole thing about what I think the entire debate, and that whole 2021 period, actually it was September 2021, that whole debate that we saw about whether inflation being transitory or not, and I may be dead wrong about this, but I firmly believe it in my heart, was that Biden wanted to appoint Lael Brainerd to be Fed chair. And there were a lot of folks at the Fed that were concerned that the Fed would have a more inflationary bias under Lael Brainerd, and that Powell wanted to continue being Fed chair. And so he put out that transitory message. And sure enough, as soon as he got reappointed, because remember we had the resurgence of COVID, and suddenly Biden had bigger fish to fry and said, you know what, I'm going to bring Brainerd in, I'm going to make her vice chair, and I'm going to I'm going to reappoint Powell, we're going to get that off the table, boom. As soon as that happened, they changed the tune on interest rates. And so as soon as that happened, it's like, this inflation problem doesn't look quite so transitory. One of the concerns that the Fed has right now is that wages are proving to be very sticky. And one of the reasons that wages are proving to be very sticky is that housing costs are up so much. Rents are up so much. And you'll hear Jeremy Siegel. If you watch CNBC at all, he comes on all the time. He gets all animated, he gets all worked up and says, they're looking at the wrong thing, you're looking at the wrong thing. I'm trying to think of who. Apartment List just came out with their numbers and rents fell last month. They fell last month. The Fed should be cutting rates, they shouldn't be raising rates. They don't look at that last number. The Consumer Price Index takes apartment rents really using the equivalent of a 12-month moving average. And the reason why they do that is that if you're an apartment renter, it doesn't matter what the rent did last month. It matters how much more you have to pay to rent that apartment when you renew your lease. And that's going to be more reflective. It's going to include some of those past increases in it. So if your apartment if it fell 0.8% last month, but it's up 11% year to year, that's what really matters. And if you're an apartment renter and your rent's up 11%, your rent makes up about a third of your expenses, and all of a sudden, boom, well, that's a big ticket item. What am I going to cut back? I need to earn more money. And so you go to your employer and say, hey, you're going to have to do something, or I'm going to have to go get another job. And the unemployment rate's 3.5%. So it's like, if you can't boost my salary, I'm going to get another job. This is why the Fed has to hold the line on inflation, and why they're not reacting to the latest dip in apartment rents, is because it falls back and we have a wage price spiral. This data is also the data that I knew, looking at this one series, which comes from the National Federation of Independent Business, that there was no way that inflation was transitory. And this is one of the simplest things to learn about economics. And I'm going to tell you two things. One, and whenever I die, this needs to get on my tombstone, economics is nothing but common sense made difficult. Just remember that. That's rule number one. But the other is that anytime you see a change in an economic statistic that is broad-based, it's real, and it's going to be lasting. And that's what this index tells you. It's a survey of 5,000 businesses. They say, how many of you raised prices in the last 3 months? And it rose to a higher level than anything we saw going all the way back to when that index began in 1974. We've had some big inflationary cycles since 1974. So if a higher proportion of businesses are raising prices, we've got a real inflation problem. Even though it's improved, it's still higher than any time that it's been since 1974. So we still have a real inflation problem. That's why I'm fairly certain the Fed's not going to cut rates this year. I'm gonna fast forward to some. This is a table, and these slides will be available. I think there's a QR code where you can download the slides. This shows you all the recessions that we've had since World War II. The average recession lasts 11 months. The shortest was 2 months, which was the pandemic, which is a very unique circumstance. The shortest before that was the 6-month one that we had in 1980, but that was when we had true double dip recessions. That 1980 recession was caused by not understanding what caused inflation. And I remember I was in college in 1980, and Jimmy Carter put credit controls on because he thought that what was causing inflation was that it's not the money supply, it's the credit supply, and then we got to put credit controls on the economy. And sure enough, as soon as you put those credit controls, the economy tanked. You took the credit controls off, the economy went back up again. Inflation was still a problem. Paul Volcker had come in kind of in between, Paul Volcker had come in and then unanchored interest rates. But the average, so I've got two averages. The average ex the pandemic is 11 months. GDP declines about 2% on average. Employment declines 3%, manufacturing employment about 11%. I think that if we're going to have a recession, it's more likely to be like the 1990 circumstance. The circumstances remind me of that. In the 1980s, we had a series of rolling recessions. It impacted agriculture. If you're a music person and you have the Farm Aid CD, if you still have CDs, I burned all my CDs and sold them. But that's where the Farm Aid thing came from. Then we had the oil bust, and then we had the collapse in New England real estate. And that's very similar to what happened. You know, we have rolling recessions going on right now. They're a little bit more condensed. But what happened as a result of those rolling recessions, the regulators felt that they got burned. They said, God, how did we miss that? How did we miss the contagion from the ag crisis? And I would have thought that the oil crisis would have brought down every bank in Texas, even the banks that didn't lend to the energy business. Well, it didn't bring down Frost Bank. There was one bank that held on. And then the New England real estate, they said, by golly, we better head on down to the south where real estate activity is still going on, and then they shut it down by basically having a special credit exam and restricting lending. So we had a relatively short recession that began right after Saddam Hussein invaded Kuwait and ended right after the success of the air war. And it lasted just 8 months. So it was a relatively short recession. GDP declined by about 2/3 as much as it normally does. It fell 1.14 instead of 2.1. And by all accounts, it was a short and shallow recession. But because it involved a credit tightening, the recovery from that recession was very slow. And the unemployment rate peaked 18 months after the recession ended. And that's one of the reasons why we elected Bill Clinton over George Bush. And it's like it was the first time that ever that you had an economy and an economic recovery where the incumbent did not win re-election. Here's a colorful chart on inflation that kind of breaks it down into 4 parts. The blue up here is energy prices, and energy prices have come down because we've drained the Strategic Petroleum Reserve. I've got to take a peek at my watch, make sure I haven't talked too long, because I may have talked too long already. But, yeah, I think I have. But I'll wrap it up in about 3 minutes. But we drained the Strategic Petroleum Reserve. The reason we have a Strategic Petroleum Reserve is not to offset prices when prices spike. That would be called a speculative oil reserve. The reason we have a Strategic Petroleum Reserve is if somebody starts sinking oil tankers somewhere around the world, probably in the Persian Gulf, and we have physical shortages of crude so that we have crude oil to maintain our economy at a reduced speed and maintain our national defense. That's why we have a Strategic Petroleum Reserve. We have drained 2/3 of it. It will take more than a decade to fill it back up. The reason it'll take so long to fill it back up is that money has to be appropriated to buy the oil, to replace what was in there. And it will not happen anywhere near as quickly as it did. The geopolitical risk around the world have gotten greater. That's where inflation came down the most. Here's food prices. I think that's going to get a little bit better. This is core goods prices in the middle. and that services price is there. I'm going to show you one last chart. I promise that this will be the last chart. And this is what I think is most important when it comes to housing. And this is the share of family income needed to make the principal and interest payments on a mortgage. And it's currently at 23.8%. And it's around $1,800 for principal and interest payments is what that would be for that's the median, a family earning the median income, which is around $75,000, buying the median priced house and putting 20% down. That is a higher proportion than it was at the peak of the housing bubble. So this is the strain that housing is under right now. It's very different from what we saw in 2008. In 2008, housing was overbuilt and it was overbought. It was overbought by people with very weak balance sheets. They either had qualified under some efforts to expand home ownership, or they were looking just to flip houses, but not in the way that they're flipping them today. People that are flipping houses today are buying a house and fixing it up and hoping to make money off of over what the improvements they put in the house. Back then, people were taking their 0% credit card applications, which there were 6 billion with a B, credit card applications mailed out to Americans in 2015. So you're not the only one that gets them every day. They come every day. Now I don't know if it's more or less now because they do it internet ways, but anyway, they were taking those 0% credit cards, and they were taking all the cash that they could get from them, and for $2,000 you could buy a new house. For $2,000 you could put $300 down, and then you did $1,700 more was due in about 2 weeks. That's all you had to put down until you closed on the house. And so you got somebody, if they got $20,000, they bought 10 houses in Orlando, and they said, well, it's going to take them about 18 months to build a house. The prices are going to go up 25%. I'm going to make 25% off of nothing because I'm not paying for the money. And that's what happened in not 2015, 2005. That's not happening today. I mean, credit is tightened to the point where we don't let people do that anymore. And today, housing is underbought because people can't afford to buy it. Credit's been tight. We're shrinking the pool of people that can qualify to buy a house. And it's underbuilt because we've made it impossible to develop homes just about anywhere. And that's something that is not going to fix itself. Not only is the demand curve for housing inelastic, the supply curve has become inelastic. And I'll leave you with this last note on here, and I'll be around afterward if people have questions, but California, like many things, California was first in this. And if you think back to California, think about the Karate Kid. Think about the movie The Karate Kid. When the Karate Kid movie came out, California had a very affordable housing market. After all, their family moved from New Jersey to California. I mean, they moved there for a better quality of life. California had it was a very affordable place to live. California's become less and less affordable as it's become harder and harder to develop in California. And so their curve got more inelastic. And so what happened is that home prices went from being 76% of the US median when the Karate Kid came out to being like 200% of the US median today. And at the same time, the curve got more inelastic. So when the supply curve is inelastic, small changes in demand give you big changes in price. And so that works both ways. And so California had ups and downs in prices before the rest of the country did. Now the whole country's got an inelastic supply curve. And so something that we never really saw before the housing bust 15 years ago, I think now is going to be endemic in the housing market, in that we're going to have repeated up and down cycles in prices. We're going to have price volatility in the housing market that's going to become a regular feature of the business cycle, or the housing cycle, which tends to be longer than one business cycle. But that's going to be something that's going to be a regular occurrence until we figure out how we're going to do something on the supply side. So that's something I wanted to leave you with on housing. I don't think we're going to solve this very well. I'm not a big critic of the single family for rent folks. The reason why there's growth in that industry is because of this. It's not a question of, oh, if we took them out of the market, housing affordability would come down. We need to build more houses. We need to find a way to build more houses. That's and that includes mobile homes or manufactured housing. That includes that as well. We need to find a way to get that, because manufactured housing, you had no growth in that industry. I mean, the industry was an industry that Warren Buffett invested in because it made so much sense to him. The problem with manufactured housing is you can't get zoning to put a manufactured housing community up today. And manufactured housing communities can be built in a way that they are a positive for a community. I mean, there have been a lot of things that have been done in that way. So, we've got to address that. So I'm going to stop right there so I don't throw us off schedule. Thank you very much.